And joining us now for more on the market action, we have Binky Chada, Chief Global Strategist at Deutsche Bank. In total, Deutsche Bank has over $1 trillion in assets under management. Binky, always good to see you.
Thank you for having me.
So start a big picture, Binky. You have a market that, of course, has roared off those April lows. You argue we should continue to keep grinding higher here. How come?
If you look at, the most basic measure of positioning that we have, which is our overall measure of equity positioning, it's a Z-score measure, so it goes between -1 and +1. We went well below -1 in the aftermath of April the 2nd. And we've been bouncing up since then, but we are still today basically at -0.5 in round numbers. So the market's still underweight, despite the fact that the market is mostly back, and we're actually higher than we were just prior to April the 2nd. I would say if you look basically within our measure of equity positioning, you break it up into systematic strategies and the fundamentals-based investors. We call them discretionary investors. And I would tee off what Julie was just saying about the market. Looks like it's not been going anywhere. And to say a strange thing, going nowhere for a while will take you up in U.S. equities, given where we are today, because if you're going nowhere, and part of that is being basically the ranges are narrowing. As ranges narrow, vol falls, and as vol falls, systematic strategies have to essentially mechanically raise exposure, which is what they're doing. So if you think about systematic strategies and how they responded to April the 2nd, I mean, we went to sort of -2, -2.5, because we got a very severe vol shock. And normally, a vol shock like we got would take quite a while basically to play out, because the market has to absorb it. It typically takes 2 months for the market to find a bottom, and here it took 1 week, and that's the clue as to why. And that is simply that normally when you have a big vol shock, the shock itself doesn't start to come down. And it is simply the fact that basically, as long as you're not getting another shock, vol is going to come down, but it's going to do that gradually. In this case, we got April the 9th, which is where the shock itself reversed. And so we have basically, as my colleague Parag, who puts out our positioning weekly, the title of his piece is "The Shortest Vol Shock Ever." And it's a lot shorter than most. So it's typically 2 months to find a bottom, and it's 4 or 5 months to climb back up. We are already higher than where we were.
Yes, we are. And this is similar actually to some research we looked at yesterday from Bespoke Investment Group, which looked at the swing in the VIX, which I think was the recovery that you pointed out was the 3rd largest on record, going back to 90 when the VIX started. So all of that, as you say, is contingent on as long as there's not another vol shock. And I don't think anyone thinks there'll be another vol shock like there was on April 9th. But what are some of the other things that could cause some friction for the continued move to the upside?
I would say the biggest issue still remains, whether you want to call it April 2nd or April the 9th, where we have the reversal.
Yeah.
The playbook from Trade War 1.0, I would argue, still holds, which is basically in Trade War 1.0, the market went into this very wide range that held for 18 months. And when we were at the bottom, we would get de-escalation, so that's parallel with April the 9th. And when we go to the top, which is kind of where we are approaching, we get April the 2nd. So, if the market does very well, I would argue that there is the risk that we get re-escalation in some form or another. But otherwise, we are basically pretty constructive. So remember that April the 2nd happened when, positioning, there's a lot of optimism after the election and early January. Positioning was already coming off, but it was still pretty high. So it was much more vulnerable. At -0.5, it's hard to say that it's really vulnerable. Now, the -0.5 is really coming from the systematic strategies. If you look at the discretionary fundamentals-based investors, they're hugging neutral. Neutral is consistent with pricing in two-sided risk. It's consistent with about mid-single-digit earnings growth in the second quarter, which happens to be our revised forecast of about 5% earnings growth. And so we shall see. But we're sort of sitting in the middle. There's plenty of upside, especially if you look at equities from a demand-supply point of view. There's positioning, which I've spoken plenty about. There's inflows. We're not really counting on that much. But one has to caveat with the fact that over the last few years, there's been an enormous inflows boom from which, across asset classes, from which equities have benefited too. And last but not least is really the buybacks. And for the buybacks, of course, earnings are important. And a feel, view, take that corporates are not going back into the bunker because that's the first thing that would get cut. Now, if you look at Q1 earnings, in Q1s is when buyback announcements tend to be on the high side. But by the standards of Q1s, we had basically record buybacks. So that's strong indication that corporates are not going back into the bunker. Of course, we also had, a 20% pullback. So if you are going to have some amount of discretionary buyback money and your equities go down by 20%, people are going to buy. So it's a combination of things. But I would argue, companies do not look at all like they're going back into the bunker. They're dealing with it. It's a shock. It's a big shock, and the extent of the tariffs remaining are still large. There's no question about that. But if you think about the hit to earnings, the prior, that was a 27% average tariff rate, which would have been a 25 percentage point increment. It was taking off about 15 percentage points from earnings this year. Where we are today, we think it's more like 5%. And 5% hit to earnings is arguably, it's not terrible, and it's still, you could argue that it's a normal variation. I mean, earnings, like everything else, but particularly earnings tend to be pretty volatile. So even in the U.S., where they're the least volatile.
And Binky, correct me if I'm wrong, your year-end target is 65.50. What are upside risks to that target that you think through?
There's plenty of upside risks. So we're assuming in our demand-supply framework, so 3 elements. Basically, what is the existing equity money likely to do? I think, like I said, that's basically sitting in the middle. Discretionary equity money is positioned completely neutral. So if they get less concerned about growth, if some of the cyclical aspects of things start to kick in, and there's plenty of them, in our outlook for the year we had 7. I remember we discussed this at one point. So if corporates start to see through the current haze, there's a lot of elements. So you take CapEx is one that's kind of been on hold for there was plenty of uncertainty the prior 2 years is what companies told us. They then raised their CapEx intentions, after the election. They then cut them drastically after the tariffs. But intentions are moving back up. So that's very, very positive, I would argue. So at a fundamental level, it's just a cycle kicking into normal gear. And this was sort of a pause for 3 months, if you want to put it that way. But we have, if you think about it in demand-supply terms, if the market gets comfortable with growth and earnings and really the reaction function to tariffs, which, April the 9th suggests basically, significant sell-off in the market is sufficient to get a relent, as we call it. A positioning is likely to go higher if there is cyclical strength in the economy, because that's where that's where the earnings come from. I'm putting or factoring in, to be conservative, no inflows, and buybacks really about earnings. And with the buybacks, I'm assuming buyback payout ratio at 50%. That's what it was in the first quarter. Normally cycles between 40% at cycle lows and 60% when corporates get very comfortable with their earnings. And so there's upside from all 3 aspects, basically. Yeah.
65.50. That's how you get there, or even higher. Binky, thank you so much for being here. Really appreciate your time.
My pleasure. Thank you for having me.